There's a very good chance you've already used a Hindustan Unilever product today. But behind those familiar soaps and shampoos, there's a financial engine that's just incredibly powerful. So today, we're going to look past the brand names to really understand what makes HUL a true titan of industry.
Right. We all know Surf Excel, Dove, Brew Coffee. They're household names. But what most of us don't know is the brilliant financial strategy that makes it all possible. It is so efficient, it's almost hard to wrap your head around. So what's the secret sauce behind HUL's incredible value creation? Well, let's find out.
Okay, so let's start at the beginning, laying the foundation. Because to really get HUL's strategy, you have to see what it's built on. This isn't just about selling consumer goods. Nope, this is about building an unshakable financial empire. And believe me, that empire is built on some serious strengths. We're talking about total market dominance in India, a portfolio of brands that are practically legendary, and financial performance that is just rock solid year after year. The key thing to understand here is that HUL is designed from the ground up for stability and, you guessed it, to keep its shareholders very, very happy. It's a true financial powerhouse. Now this is where it gets really interesting. We're about to see how HUL has achieved something that sounds almost impossible, a negative cash machine. And it's all done through the brilliant management of something called working capital. See, when you're selling products on the massive scale that HUL does, managing the flow of cash isn't just important, it is everything. If you get it right, you can literally fund your own growth. But if you get it wrong, you could face a major cash crunch, even if you're profitable on paper. For HUL, this isn't just some boring operational task. It's the very heart of their financial strategy. So how do they do it? Well, it all boils down to one key metric, the cash conversion cycle, or CCC for short. Just think of it like this. It's the time it takes from spending money on raw materials to actually getting that cash back in your pocket from a sale. For most businesses, the goal is to make this cycle as short as possible. But HUL takes this to a whole other level. Their average cash conversion cycle is negative 47 days. That's right, negative. It sounds like it shouldn't be possible, right? So what on earth does a negative CC actually mean? This really puts it into perspective. A negative CCC means Unilever gets the cash from its customers a full month and a half before it even has to pay its own suppliers for the materials. Just imagine that for your own business. It's an unbelievably powerful financial position to be in.
So how does this magic trick actually work? Well, it's a three-part system. First, HUL's inventory sells at lightning speed. Stuff just flies off the shelves. Second, they collect the cash from those sales super fast, usually in just a couple of weeks. And third, and this is the kicker, they have very generous payment terms with their suppliers. The result? HUL is basically using its suppliers' money to run its business. It's a true cash-generating machine.
Okay, so with all of this extra cash sloshing around, what does HUL do with it? Well, they give it back to the people who own the company, the shareholders. And let me tell you, their dividend policy is something of a masterclass. And as you can see here, this isn't a one-time thing. HUL is deeply committed to growing its dividends consistently, year after year. The payout per share just keeps climbing. This isn't an accident. It's a very deliberate strategy to reward their investors. Now, get this. HUL's average dividend payout ratio is around 101%. Yes, you heard that right. That means they're paying out every single rupee of profit they make, and sometimes even a little more from their reserves. It's an incredibly generous policy. And a policy like this, it sends a powerful message. It screams that HUL's management is unbelievably confident about future profits. They're so sure that the cash will just keep rolling in that they're happy to give almost all of it back to their shareholders. It's the ultimate power move.
But come on, with an operation this efficient and a dividend policy this generous, there has to be a catch, right? There's always a catch. So what's the real value of HUL, and what are the risks we should be thinking about?
And this is where we see a huge gap between theory and reality. A standard financial analysis, based purely on earnings, might say HUL is worth around 500 rupees per share. But the actual market price, it's trading for more than 4 times that amount. That huge difference is the premium that investors are willing to pay.
So why on earth would anyone pay so much more? Because they're not just buying earnings, they're buying safety. HUL has practically zero debt. Its profits are incredibly stable. It's the undisputed king of the market. And let's be honest, people will always need soap and shampoo. You're not just investing in a company, you're investing in a financial fortress.
All right, so after all this incredible success,
how does a giant like HUL stay on top of its game? Let's take a look at some key recommendations for the road ahead. What's the playbook from here?
Well, the future for HUL is all about smart, disciplined growth. That means keeping dividend increases tied to actual earnings growth. It means being really transparent about how they're investing for the future. It means using other tools like share buybacks when it makes sense. And probably most importantly, it means constantly stress testing their financial model to make sure it's strong enough to handle any storm that comes its way.
So, if there's one key takeaway from all of this, it's this. HUL is a beautifully integrated system. Its incredible operational efficiency is the engine that generates the cash for massive shareholder returns. And that powerful 1-2 punch is exactly what justifies its premium price tag and makes it such a stable, sought-after investment.
HUL really has created a financial fortress that seems almost unshakable. But, that leaves us with one big lingering question. In a world that's changing faster than ever, what happens when a true disruption comes along? What happens when the company that seems disruptor-proof finally faces a real challenge? Now that is the billion-dollar question that will define